Good afternoon, good morning. Come on in, everybody. We'll let some folks trickle in. We are going to be allowing folks to, the Q&A section is open, so let's test it out to make sure it's working and throw in there where you're calling in from or what kind of public service work you do, either one of those questions in the Q&A section. So not in the comments, but in the Q&A section. Let's see if that is working for everybody. And if not, I'll fix it promptly. Let's see. I don't see any yet. Okay, here we go. Calling in from Memphis. Awesome. Washington, D.C. Chicago. That's where Dan is. Cool. Okay, so that's working. So yeah, Q&A section is where you could drop some questions to make this a little more targeted towards what you'd like to chat about today. But I'm Megan McGuire, Senior Consultant with Student Loan Planner and also Financial Planner with SLP Wealth. And today I've got Sam, Dan, and Kathleen with me. Sam, do you want to introduce yourself and we'll go around?
Sure. Yeah. No, I'm Sam. I'm also on the student loan planner side, but I am also a financial planner with SLP Wealth. And unique to today's title, I'm a former planner with TIAA too.
We got a spy in here. Dan.
I'm Dan Ricker, a senior consultant at Student Loan Planner, also work on the SLP Wealth side. I'm really excited to be here. I feel unqualified compared to Sam, but I'll do my best.
She makes a lot of us feel that way. And Kathleen, what about you?
Hey everyone, my name is Kathleen Boyd. I am also a consultant on the student loan planner side and a financial planner on the SLP Wealth side. And when I'm not advising on finances, I work part-time as a college professor. So shout out to all of my teachers on the call.
So cool. Love it. Well, cool. Let me go ahead and pull up our slide deck for today, but we're going to keep it fun. Talk about definitely things that might be on your mind. So we'll tie some things into student loans today, because I know student loans might be a big pain point for those on this call. This will be recorded, so if you've registered and you wanted to come back to something later, you will get a copy of the recording later today. I'll send out an email. If your friends couldn't make it, again, they'll get a copy of the recording later on as well. And again, please drop questions in the Q&A section, and we'll go through them as we go live. Let's see. Any top of the thought, things before we should jump in? Just going to check the chat real quick. Yeah, if you have questions, just throw in the Q&A section, ideally, because that's how you can see those questions later when you get the registration link. So, but let's jump into it. So today we're really going to be talking to a lot of nonprofit folks, folks in education, folks in government, and almost all of you should probably have heard or have what might show up on your statement as TIAA, or what used to be called TIAA CREF. So let's jump into 5 quick facts about TIAA, and I'm going to throw that over to you, Sam. Oh, yep.
So,
Rookie.
I've only been working remotely for like 4 years, of course. Like, why would I still get caught up on mute? But the reason why, we can generalize the idea of like a lot of people having at one point in time exposure to TIAA is because they were originally a teachers company, right? That's actually, TIAA stands for Teacher Insurance and Annuity Association. They do not do insurance anymore, but they've kept the name. Is that while they did start as a teachers company, they have branched out into research, medical, and just overall education fields, as well as, I believe, research too. So kind of the whole realm of things. And they're also kind of known and kind of they're very upfront about it. It's like they are the pioneer of annuities, not necessarily trying to sell you an annuity, but providing potential guaranteed lifetime income options within your retirement plans with your employer that may be kind of managed by TIAA. So these retirement plans can have anywhere from, they operate like 401ks in most parts. They're 403bs, right? That's usually for 501c nonprofits, or in some cases you might see a 401a at TIAA too, or have exposure there. But for your kind of knowledge, right, is you can usually make your own kind of salary deferrals, retirement contributions there, like it was a regular 401k if you were working for a private company. You're going to be given each retirement plan is going to have a set lineup of investments. These investment fund options, right, are going to be set by a plan sponsor or a retirement committee that is either advised by a third-party consultant, or even sometimes TIAA will help, but it is kind of a process that not necessarily, like TIAA is not deciding what the investments are generally in the plan always. And for people like maybe if you've been investing with them for a while, or maybe your parents invested with them or their parents invest, they were originally known as TIAA CREF. And it's not necessarily that's gone away, but as they have grown as a company, they've kind of, and have had different types of business lines of revenue that have come out, they've kind of just dropped the CREF at that point. So that way they can just know all their business lines as TIAA at that point. So just some 5 quick facts of a little bit of history to give you some background on that.
Yep. And retirement, like we're going to go into talking about retirement here in a second, which might seem like early if you're in the first few years of your career, if you're still, pretty far away that you think from retirement. But it is like literally is never too early to think about saving for retirement and to start putting money away. And there are some huge benefits to saving in your retirement account that they're mutually exclusive with benefits to your student loan plans. Like your student loan repayment plan could be positively impacted by you contributing to retirement. So if you're responsible in that area, the retirement area, it's also going to translate into some positive results to your student loan plan, which we'll talk about a little bit later. But let's kind of break down some ways to think about retirement, because I think sometimes that's like a big overarching, like kind of like question mark for folks. Like, I don't even know what that looks like. I'm not even there yet. I don't want to think about it. But these are some 4 ways that we could think about income streams in retirement. You want to break those down, Sam?
Yeah, and the reason we chose these 4, they're not necessarily like, you might know them by other names, you might, and there's definitely maybe other ways to think about this, but I think these are going to be the 4 that you typically are going to see presented to you, whether you are with TIAA, but also generally how we sometimes are going to think about this, because I think, I can't speak for everyone here, but you're kind of like, you're led, you get a job, you start saving for retirement, but no one really tells you to, how do you think about taking income in retirement? Like, how do you, like, obviously if you're in your 30s, your 20s, even your 40s right now, you're like, I'm just trying to, get my student loans forgiven,
survive.
or I'm out here just trying to survive. Have you seen inflation? But I think there doesn't hurt to really understand how actions you take today can set up, or just having that perspective can make it easier down the line. And so we broke it down into 4. The first one being lump sum. So like when you retire, set off into the sunset, right? Or maybe you do not the traditional way of retirement. Maybe you do semi-retirement, or what they call FIRE, or you take an emergency sabbatical and maybe just never come back. But a lump sum is something that is available to you at an appropriate retirement age based off of your plan. Most are going to be 59 and a half or higher. And you can, if when you take a lump sum, it's usually going to be a big bulk of money at once that comes to you. It's not always, sometimes it makes sense, sometimes it's not. And, this one's listed number 1, but I would say out of the, I think number 2 is where we're going to see the most common. So systematic. Think of those as maybe also periodic distributions, like you setting up as kind of like a reoccurring set frequency amount of money to come to you, whether it mimics a former paycheck of yours, so bi-weekly, monthly, quarterly, semi-annually. These are going to usually, these can be flexible. Like you can change, you can increase, you can decrease it. You might have multiple systematics coming to you from different firms that you're coordinating retirement with. Then there is RMDs, required minimum distributions. And some of you could possibly be 40 years away or so from this actually happening for you. But this is something that is for certain qualified accounts that have what they refer to as pre-tax dollars, right? That's the same that help with your AGI for student loan purposes. But the IRS essentially just gets tired of you tax deferring that at a certain age. For anyone born after 1960, right now that's going to be 75, is you are going to kind of be forced to take a minimum amount out each year. So from January 1st to December 31st of a year, you're going to be forced to have a certain amount come out based off of your annual ending account balance from the previous year. It's not meant to deplete the account. It's not something to be super scared about. There is some potential strategy over your career with this, but this is kind of like something that think of this as kind of like a cause that comes on to you, not necessarily something you don't choose this life. This life chooses you in a sense. And
It
then,
is kind of interesting though. You do say it right. It's like the IRS, like they want their money. Like it's
yeah.
like taking it back. Like these first three things that we've listed here, this all does have to do with your like contributions that you're making. Like you're just like a savings account. You're putting money into this over time, years and years and years of work, and
Yeah.
it's growing into this nice big lump sum bucket, right? It's let's
Mhm.
say it's a big bucket that you could either draw from. You could take a big chunk out of it. You could, when you go to retire, you could pretend like you're still going to get paychecks and, basically take your paycheck amount from it, or RMDs. So RMDs, like you were saying, come into play. And this is pre-tax money, right? So it has never been taxed. This money that's in this big bucket has never been taxed. So the IRS is looking at it, looking at your age, and they're thinking, hey, it's about time to start taking money out of this, right? So
We need to get paid.
right. We need to get paid. So there's definitely strategy around like RMDs, like minimizing what that might look like for you, classifying assets, converting assets into non-taxable money. So lots of strategy there, but not meant to scare you. But that is something
Mhm.
that you're going to hear at some point. RMDs are going to be part of potentially a lot of people's like retirement distribution journey.
Yeah. It's something you might not have to be worried about, but something your parents might be already kind of undergoing at this point too. So, this happens to everyone. This isn't something that is just specifically happening to people who work in nonprofit, for example. Um, then
Yeah.
lifetime income, the power to have essentially a paycheck for life, right? There's many different risks out there when it comes to saving for retirement, right? I think market risk is the one that gets all the love, right? But there's a lot of other risks out there, such as interest rate risk, uh, liquidity risk. But one thing that I think gets overlooked a lot is longevity risk, right? The risk of outliving your money. Outside of the pandemic, people are living longer than ever, right? Just due to medical advances, biology, all of that. And I think sometimes, there's typically three sources of lifetime income out there. You have pensions that can be through the state or your employer, or even the federal government sometimes. There is Social Security, right? Of course, there's elephant in the room with that, but we're not going to get into that animal today. And then there is, annuities, right? They're typically going to be for the people who might not have available pensions or uncertainty with Social Security. But lifetime, everybody should be looking at some point or another, like, what is my paycheck for, like, how can I replace a portion of my paycheck for life at one point? That's a bigger question that you should be asking yourself at different points throughout your life. It's not essential, like, don't have to have a crisis about it right now, but, that is a consideration that can go along. And one thing I want to make very clear about this, I think 3 is a little bit more excluded here, but for 1, 2, and 4, these aren't mutually like independent or exclusive of each other. Like, you can coordinate more than one. You could have a lifetime, a pension coming out to you, or an annuity, or annuitized, right? Or you could have Social Security, but then at the same time, you might have other money that you've saved in your 403b or your 401a or 401k, that you have coming to you systematically, a set amount that you defined that is flexible for you to change, start, edit, stop. And then there might be times in your life where you do need to take a lump sum withdrawal, whether it's, make a decision that you need to fund a down payment on something in retirement, or, you suddenly need a new fridge, right? Like, those things, right? So a lot of these, I want to make very clear, they work together in many cases.
Yep. Yeah, like blended or a combination of. I feel like it's very rare where we're always like, this is the way and this is the only way. It's like, no, there's a lot of different things that we could pull in. That's the beauty of planning, I think, of
Yeah.
pulling these things together. So speaking about, buckets like that we're growing and accumulating with savings and funds over time, there are really three different tax buckets that we're putting money into. Right. So we've got pre-tax, post-tax, and taxable. And I think Dan, you were gonna jump into these fire buckets that we threw over here, right? So
Um, Sure. Yeah. I think Kathleen will get the next slide. I can prep that a little bit. We've got, these three sections that, or I guess we could lump them into groups, pre-tax, post-tax, taxable. Pre-tax is a word that we use in our industry. It's also maybe called traditional if you're looking at your 403b. And it just means that you don't pay federal income tax. And if you live in a state that does state income taxes, you don't pay state income taxes. But generally with pre-tax type of accounts, that could be a 403B, a 401k, a 401A, a 457. While you don't pay those federal or state income taxes, and usually you also don't pay local tax, you usually pay Social Security and Medicare tax. The only kind of pre-tax account that skirts that is a health savings account or a flexible spending account. Post-tax, that's a term that we use for account types like a Roth IRA, but also for account types like a Roth 401k. A lot of times people get Roth 401k and or Roth 403b confused with a Roth IRA. They are different. They act the same. They are post-tax. The growth is tax-free. And then taxable, that's a third bucket that is maybe it's an account that's in your own name at name your custodian, just like your checking account or savings account is. But instead of it being in cash, it can be invested. So it might be in your own name. It might be in joint name with you and a partner. It might be in joint name with you and a sibling or another family member. It also could be titled in trust. So it might be your family name trust or something like that. Which is a good segue in for Kathleen.
Yeah. Thanks, Dan. So what Dan just explained, this is what we refer to as tax diversification. Okay, oftentimes when we're saving for retirement and we think about diversification, we think about it from the standpoint of what we're investing in, right? We've got to have a little bit of money in stocks, a little bit of money in bonds, real estate, and so forth, also known as asset allocation. And that is incredibly important, don't get me wrong. But this tax diversification, we believe, is equally as important. It's making use of a variety of these investment accounts that have different tax treatments to maximize your after-tax returns. And this can be carried out using something called the three-bucket strategy. Okay, the pre-tax, the post-tax, the taxable that Dan talked about. So what exactly does this look like in the context of a retirement savings strategy? Okay,
I could tell you're a teacher, Kathleen. You're totally a teacher. I love this.
Well, thank you. So what does this look like in the context of a retirement savings strategy? Let's start with that pre-tax bucket, the one up at the top that's in green there. Okay, so this is your 401k. Okay, this is your 403b if you work for a nonprofit. This is your 457 plan if you work for a government entity. Okay, all the money that is contributed to that account is considered pre-tax, meaning you haven't been taxed on that money. And likely what happened is when you contributed to it, you got a tax benefit in the form of a deduction that lowered your AGI or your adjusted gross income, which can be great if you have student loans and you're on an income-driven payment plan. Your payment is based on your AGI. So the more you funnel into those pre-tax accounts, the lower you can get your AGI and the lower you can get your payments. Now, when it comes time to take that money out, it is going to be taxed, okay? And it's going to be taxed at whatever ordinary marginal income rate you are at that time, okay? Then we have the tax-free bucket there in purple. So this is your Roth IRA. This is the Roth portion of your 401k or 403b if you have that available. This could also be, I would put HSA, health savings accounts, in that bucket too, because you can withdraw money from a health savings account tax-free for medical expenses specifically.
Yeah, we're a big fan of the HSA on this staff, aren't we?
Yeah, we are. I actually think HSA is one of the best types of savings accounts that you could have access to. We could do a whole webinar on HSAs. But yeah, so I would put that in that bucket. And so when it comes time to pull that out, that's different from the pre-tax in that that's pulled out tax-free. That is not money that is reported on your tax return, okay? Then we have that third bucket in gray there. That's the taxable account. Again, technically, this is not a retirement account per se, in that it's not subject to the same rules that retirement accounts are, such as you can't pull money out to your age 59 and a half and such. You can pull money out of a taxable brokerage account at any time. And so this creates some flexibility around how you take out money, when you take out money. The brokerage account also is subject to different tax rates than the pre-tax money is. The taxes you pay on a brokerage account, you pay when the assets appreciate and then you sell. Okay, and then those gains are subject to what we call capital gains taxes, which are lower rates than your ordinary income tax rates that you're subject to with the pre-tax accounts. Now, Dan is going to get into this a little bit more in the next slide, but a couple of things I wanted to point to is some real world examples of how I've seen clients benefit from this 3-bucket strategy. I want to post a question in the chat. If you had to guess, what do you think is your largest expense or would be your largest expense during your retirement years? Somebody can guess that.
Answers. Yeah, in the chat or in the
Q&A. Excuse me. Yeah, we're doing the Q&A.
Yeah, either way.
And then while you're doing that, I think that just there was a question about the HSAs. Like, can anyone contribute to an HSA? Yes, anybody can contribute to an HSA if they have a high deductible health plan. And the amount you can contribute is a more layered answer. But I'll suffice to say, there's a single person maximum and a family maximum. And sometimes your employer will contribute too, because they want to thank you for being on a less expensive healthcare plan. So they'll contribute, and whatever they contribute is part of your maximum. It's not whatever you contribute plus theirs.
And one more point to add too, like we love HSAs because of the tax benefits, but we realize that we can sit here as maybe someone who doesn't have a family of 5, maybe that. And so if you have sometimes a plan, benefit plans will offer stuff like high deductible plans versus like a PPO or an HMO. The PPO or HMO might be more expensive on a benefit basis, but the
monthly premium basis, right?
The monthly premium basis, but it could ultimately save the family more costs, right? If they're going to be using this benefit. The reason why it's called a high deductible plan is more is out of pocket up front. So this is going to be, while HSAs are great and we love them, high deductible plans are more suitable for either people who don't expect to use their health benefits as much, or the high deductible plan, or let's say a relatively very healthy family, right? In that sense.
Or really, really healthy emergency savings fund.
Exactly. Yes. And
Sorry, Kathleen. We didn't mean to derail you.
Yeah, no problem. No, great question about the HSA. Great points. Okay, so going back to the original question is, what do you anticipate would be the highest expense or one of the highest expenses you're going to have in retirement? I'm looking at the Q&A, almost every single person mentioned healthcare, and you hit the nail on the head there. Okay, that is typically going to be your biggest expense because as you age, you tend to have more health ailments. And so understanding that, and also understanding that I can write off my medical expenses, I want to make sure that I have income to recognize in order to write off those expenses, which means I need money in those pre-tax and taxable accounts that I can report on my tax return and then have the ability to write off those medical expenses. Another example where I've seen this 3-bucket strategy be beneficial, can somebody tell me in the chat, what happens when you turn age 65? What does the government require of you when you turn age 65? Exactly, Dino. Medicare. So we all have to sign up for Medicare, return age 65, and we have to pay Medicare premiums. But did you know the amount of premiums you pay is based on your income, right? So knowing that, I have the opportunity to be strategic with these 3 buckets and how I recognize income. Maybe I don't take as much money out of the 401k or 403b or IRA. Maybe I balance it a little and I take more money out of the Roth. So I minimize the amount of income I'm recognizing on my tax return, which gives me the ability to minimize the Medicare premiums I pay. Okay, this is the kind of thinking ahead and advanced planning that a tax efficient retirement plan requires. It's something we help our clients with every day.
Mm-hmm. Yeah, and that's why it's also something that like it might seem too early right now to be thinking about these things, but not really. Like these buckets, like contributions going into these buckets will happen for years and years and years to come. And if you're, not necessarily blindly putting money into savings, because that's still a great thing. Like saving money versus not saving money is way better than not saving money. But if we're not super strategic, like some of these strategies that are pretty cool to execute or to try to help reduce, taxes in the future or help reduce expenses for health care premiums, like that type of thing. Like we can't do that in the last couple of years leading up to retirement. We can't go back and like unwind all the things that we've done in the past or fix it in that short amount of time. So proactive planning can be really helpful. And these are the types of things that like aren't fun to think about. Like you don't research this on a Saturday morning, right? Drinking your coffee. Most people don't, but we do because this is our profession. We love this stuff. So
I felt attacked by that statement, Megan, there for a second.
Yeah, we're in the right profession, I think. If you're doing that, talk to us about joining as an advisor.
Okay,
Cool.
so this is a follow-up to the previous slide, and what it represents, I'm going to weave a story around, but these are the current tax brackets, the today tax brackets, which are frankly like historically low. Google 1979, 1980,
I was just
1981.
about to say, go look at the 70s.
Yeah. We've got like the highest marginal tax rate is closing on or around 70%. So today's tax rates, people talk about and complain about taxes, but they're actually super low. And how our federal tax system works is progressive. That means that for the first $23,200 in our on-screen example, for a married couple filing jointly, you will pay 10% tax. And then the very next dollar starts to pay 12% tax. So what you end up with if you make, say, $100,000 is you completely fill the 10 and 12% brackets, and your last $6,000 or thereabouts pays 22% on every dollar. So your blended rate is more like 14%, or your average rate. As soon as you make $94,301, that does not mean that every dollar gets taxed 22%. So, if you're looking for a new job and you're going out there, you don't want to go, oh, no, I can't take that one. It's $94,301. I'm going to pay too much in tax. Take the highest offer, the best offer for money and for lifestyle and balance, all that. Now, what this screen is really about is in retirement, when you've saved what you've saved, and most of us here presenting or all of us have worked with people who are retirees, and our main audience are people who are not retirees today. But we started on the side of the industry that was aimed at working with people who are retirees. So put yourself in the shoes or in the seat of a 65-year-old. Whatever they have saved is what they have. And a financial planner's main job is figuring out how to creatively help that retiree walk through retirement in a tax efficient way, but in a way like all we have to work with is what they've saved. And if everything they've saved is in that first bucket at the top, there's not a whole lot we can do to help them control their tax rate in retirement. So what we do when we work with someone early on is we help them balance where they're saving along the way for different reasons. I'll give you an easy example. Megan, Sam, Kathleen, and I do a lot of Parent Plus calls. That's because the cost of education has gone up significantly. It has outpaced inflation by a long shot since the 70s. And a lot of people who were earnestly saving along the way just couldn't keep up with the cost of education. And so what they end up doing, instead of taking 9 to 12% private variable rate loans for their kids in undergrad, they take 6, 7, 8% rate Parent Plus loans. And what they come out with is, on the other end, is their kids in grad school or their kids off and working, but growing in their own profession, and they're stuck holding these $100,000, $200,000, $300,000 Parent Plus loan balances. And they're also trying to balance that, paying that back with, or paying that back in some way with retirement. Well, if you are a 65-year-old with a Parent Plus portfolio of loans and you're retiring, you don't want everything that you've saved in traditional 403B at TIAA. You want a mixture, because if you file married filing separately, like we would like you to be able to, and your income is over 103,000, your Medicare premiums are $5,000 higher per year every year than they could have been. So, like, how you file married filing separate, married filing jointly, if some of that money was in a Roth 403B or in a taxable account, maybe the amount that goes through the tax meter would have been less. You still live on the same dollar amount, but it's more tax efficient, and you could file married filing separately and exclude your spouse's income on an income-driven plan for your student loans. So there's things that we can do if we have more time to work with someone to help them strategically capture, we understand the student loan environment, which I think uniquely places us amongst financial planners in just a different section. And we can apply it to things like the 3-bucket strategy, which is more, it's out there. And a lot of financial planners love educating folks on it. And we take that and level up with student loans and taxes.
Mm-hmm. I actually didn't know what I didn't know what you were going to ask Kathleen. So I didn't have the answer in my head. I figured probably healthcare, but actually the first thought that came to my mind, the most expensive thing in retirement, I was going to say taxes,
Yeah.
because I mean, that is going to be an expense in retirement one way or another, unless you've got all of your money completely tax free, which is rare. But yeah, that's why, like, taxes on a ongoing basis, like year to year, we're in tax season right now. Taxes are, of course, part of our yearly daily life. They come from our paychecks. But tax strategy in the future could be really helpful for, of course, retirement, but also like tying into student loans, which Parent Plus loans are a really interesting example because we are seeing more and more of those. So we have to do a little more planning around like borrowing loans later on in life if you plan on paying those back, like not delegating those to your kids in the future. But also like trying to manage it all. Like like just talking about this makes me feel a little overwhelmed. And so I could understand how like you might feel like thinking about or talking about all these different things, and having a good clear cut plan could help you get to the other side a little easier and a little less stressful.
I
Now,
will
did you want to
say,
touch on? Oh yeah, go ahead.
I guess I would say something in an add-on to that HSA health savings account thing from earlier. That fits in that tax-free bucket down below. It's completely tax-free. You put money in, you let it sit there, you don't spend it over at Walgreens or CVS on Gatorade. You invest it, and it grows tax-free like a Roth, and then you spend it on Medicare premiums. And you could max out an HSA every year between now and retirement, and there's a good likelihood you empty that account, even though it's invested in doubles every 12 years, perhaps. You would empty it in the first 10 years. The cost of healthcare has paced with or outpaced education costs. So John Oliver did that segment on education costs from the Q&A here. He didn't do a segment on healthcare, and healthcare is even scarier. So, how you pay for it, you can pay for it with a pre-tax account, or you can pay for it with a tax-free account. That's why we love HSAs.
Mm-hmm. Yeah. And a couple of questions I figured we'd just talk about verbally. So one question was, do we have to have an HSA through the employer? And yes and no. So you have to have a high deductible health plan. That's number one. So you have to be enrolled in a high deductible healthcare plan through work, or through open market. Yeah. Or self-employment open market. I'm actually, for myself, I actually have a I'm on open market. I have a high deductible healthcare plan. It allows me to have an HSA. But if your employer doesn't specifically offer an HSA, which sometimes that's the case, you can go and open one independently as long as you have that high deductible healthcare plan. Same thing, if you're on open market, you can go and open one up on your own. There's a couple custodians that you can consider doing that with. Do you have any favorites, Sam, Dan, Kathleen?
I think the one I have the most experience with, I don't know if it's my favorite, is Health Equity. I think that's that's a
Yeah.
pretty popular one through the employer workplace, I think.
That's literally who I have actually.
There's Optum Bank as well. Fidelity has an HSA.
Mhm.
A lot of times the health savings account provider that your employer picks. So if they provide an HSA, you can't really pick a different one, but they will behind the scenes usually have a custodian, a Fidelity, a Vanguard, a Schwab, that kind of thing. But Fidelity offers an HSA, and we're hoping that Altrist, our custodian, offers an HSA in the future. I think it's on the roadmap.
Yeah.
Yeah, I'm a huge fan of Lively. I have my HSA with Lively. And may I add a little known secret about the HSA while we're on this topic?
Oh yeah, definitely.
What a lot of people don't know is, while yes, you can take the money out for medical expenses tax-free, the IRS also, when you turn age 65, allows you to take the money out for any purpose, penalty-free. It's still going to be taxed though, but you can take it out for non-medical expenses, penalty-free. So now it doubles as another retirement savings vehicle for you. You could use it that way, potentially.
Kind of add, like, I'm not trying to turn this into the HSA webinar because I'm sure
Yeah.
we'll have a future one coming too. But what Kathleen just said adds a very critical planning element. So like, not saying that this is the way to do it, but traditional financial planning, especially traditional financial planning that is not student loan sensitive, right? They have you on this kind of traditional path of how you withdraw income. You might draw your taxable income first, right? You then might go move on to your tax deferred, like that, because that is available to you in your 50s, right? But you maybe early on in your 60s, if you're still working and maybe you're part-time, you're pulling from taxable because it's a more friendly rate right now than your tax deferred marginal rate might be. But then you might move on to your tax deferred rate in kind of like as you start retirement or in kind of the like first quarter of it, because not only because that might be what you have a lot of, but also RMDs that we discussed earlier. But then usually traditional planning might have you do the Roth and HSA like later on at the end of, because like things that Kathleen touched on, trying to keep your income lower for premiums and other qualifying credits. And not saying that is the wrong way. That has worked for many people, but sometimes, especially if you're a parent plus borrower, or you're going to be a parent plus borrower, or if you're someone who's trying to retire early before 59 and a half, there might be some more creative planning that has to happen, knowing that you might need to contribute more in the tax deferred bucket because of student loans to keep them less and low, right? So I think, well, the point I'm trying to make here is that there's necessarily no right or wrong way to do how much to put in each. As long as you're doing the 3 buckets, you're good. But I will say there can be extra value added earlier on by knowing maybe, how your plan to save will change over the next 10, 20 years because of your student loans, and things you need to think about in your 40s and 50s to get you prepared for how you draw income in retirement.
Mm-hmm. That's a great point. Yeah, because life is on a straight line. All of us know that, right? And so our planning can't really be a straight line. We will have some adjustments over time. One phase of your life might make more sense for pre-tax money, like when we have student loans. Another phase in your life might make more sense for tax-free money. I think Travis is making an appearance. Did you see his face pop up?
Yeah, that usually means he wants us to move forward. Get a step on.
But that is a really great segue actually into student loan stuff. So let's chat a little bit about student loans, because of course, if you're sitting in on this call, you are working in a public service capacity. You're probably following our newsletter because you have student loans, or you will be, borrowing student loans. So it would be, irresponsible of us to not talk about public service loan forgiveness, because that is a very relevant program to you guys. So PSLF, public service loan forgiveness, there are 4 requirements that we have to check the box for to be eligible for this loan forgiveness plan. First is we have to work full time, which they have now simplified. There used to be kind of a complicated definition for this, but they've simplified this into 30 hours a week on average, working for an eligible employer. So that's any government entity, any 501c3 nonprofit entity. You can check to make sure that your employer is eligible on the studentaid.gov website, which is pretty handy. You could check, actually, everybody just recently got W-2s from their job. So the EIN number is on that W-2 that you can go run in the student loan system to double check. So pretty cool there. But if you have a TIA, you're likely going to be eligible. So that's pretty cool. We have to have federal direct loans. So our loans have to be federally held and they have to be direct loans. If you had borrowed before 2010, so think back to like when you first borrowed student loans, if you have some older loans from pre 2010, you might want to just double check your loan file to make sure that you don't have what's called FFEL loans or Family Federal Education Loans or Perkins loans. Those loan types, they used to be issued back in the day. They don't issue them now, but they are not eligible for this PSLF program. They can be, though. We can fix them, right? April 30th is the deadline to kind of fix these wrong types of loans. So you just have to do a consolidation by April 30th to convert those loans into direct loans. If you borrowed after 2010, you're likely good. We probably have the right types of loans. Only little star, right? There's always like a if, then, but exception. If you have Parent Plus loans, that is a little bit of an exception, right? Because if you look at your loan file, it'll say direct Parent Plus. So it says direct, but Parent Plus loans are not actually eligible for PSLF after April 30th in their raw form. You would have to consolidate those to be eligible going forward, but they do retain their prior eligible or their prior credit. So there's a whole lot going on with this IDR waiver that you've probably read about in our newsletter. But if you have Parent Plus loans, it's probably worth doing a consultation to figure out what your next steps are going to be. We can check, if you have questions, throw them in the Q&A and we can circle back around and do a little more, conversation around that if that would be helpful. But the third requirement is we have to be on an income-driven repayment plan. There are 4 different income-driven plans. The cheapest, if we're going for PSLF, it's going to be that SAVE plan, SAVE. That's brand new. It's available. You can enroll in it. It's 10% of discretionary income if you have graduate school loans. The cool part is it's 5% of discretionary income for undergraduate loans starting in July. So not yet, but starting in July, that payment will drop down. And we have to make 120 qualifying payments. So that just means that we have to have all of these things checked off. Like these boxes have to be checked before they'll qualify a payment. And it is retroactive, so they'll look back at prior work history. And once we hit 120 payments or 10 years, if you're completely consecutive, whatever balance is left over on the loans is then forgiven through PSLF. So it's a really cool, very real program that does work. So those are some of the nuts and bolts of the program. But were there any interesting questions we should highlight? I wasn't checking while we were going through that.
While we're looking through that, I actually want to bring a point up, since we are probably addressing maybe some teachers and professors on this call, that PSLF has long been a nuisance for them because the term like full-time employment was very vague for so long. So this, not only have they kind of reworked the definition of full-time as like 30 plus average, they also finally added some color to like, what we think of qualifying someone in education should count as, right? So if you are someone who is like, because I know sometimes if you're a teacher, right, you only maybe work 8-9 months out of the year. As long as you have that contractual or employment period of 8 months in a year, for like if elementary, secondary school teachers, you're going to be counted as full-time for the entire year for PSLF standards. Also, if you're, let's say you're adjunct or part-time lecturer where you're not kind of like on the tenure track at an institution, right, higher ed, you're going to be basically, if you multiply each credit or contact hour taught per week by 3.35, I think. Someone correct me on that if I'm off.
Yeah, that's right.
It meets the amount. And so I think what going back to student loan advice planning, I personally, and Kathleen too, we work a lot with teachers and professors specifically, where we are sometimes when a professor reaches a point where they're like, I've had enough. But I'm ready to step back and take it start to go to a reduced role. One thing we want to look at is if they're still going for PSLF, what is the least amount that they could work and still have qualifying employment? Right. So that's kind of like having that perspective in line, because we want to make sure at the end of the day, if you're making payments and you're still working for a qualified employer, that you're going to meet that full time by their standard.
We got a really good question in the chat. And I did mention a deadline that might panic some folks. So let's talk about that for a second. So the IDR waiver that's going on right now, it could have been called IDR account adjustment. People have been calling it different things, but anyways, it expires April 30th. So not this month, but next month, April 30th. And so this person in the chat went ahead and consolidated their loans, but they haven't applied for PSLF yet. They left public service, but they're considering going back and would need another 5 years. So this is a great example of someone who should pay attention to this deadline. So consolidating your loans, that's combining the loans within the federal system that used to erase your payment history if you had payment history on your loans, which is bad, right? That was really hurtful. The IDR waiver has completely amended that. What they're doing is they're looking back at prior payment history, even before consolidations, and they're counting that towards PSLF. I think they realized, hey, that's unfair, right? And so why that's important is I do think it would make sense for that person to go ahead and submit their PSLF application by April 30th to make sure that all of that prior credit prior to the consolidation that they had just done counts towards PSLF. And what's great about that too is it's banked. So we get to keep that credit, let's say like 5 years of credit, even if we're not in public service right now. We've got it we've got it on lock to where if we go back into public service later, we can pick back up and continue on with our payment journey from there, only having 5 years left. So I would suggest if you have not submitted PSLF forms for prior eligible employment while you were, while you had loans, while you were making payments on your loans, make sure to go submit those documents, ideally before April 30th, to make sure that all the IDR waiver provisions are applied to your past balance. So another question for PSLF, how do you have to be paid via W-2 or can it be 1099? So trick question. If you live in California or Texas, there is really just this exception is if you are in a state, California or Texas is the biggest example right now, that prevents you from being hired directly to an eligible employer. So, for example, this is really impacting physicians in California and Texas, where they're not able to be hired directly by nonprofit hospital systems by state law. Like state law prohibits it for whatever reason. Right? Am I saying that right, Kathleen? I know you're actually in California.
Yes, yes.
Yep. So they've carved out a provision for those people who are prevented by state law to have access to PSLF because otherwise they would be eligible. If they're working in the hospital system, they're doing the same job. They're paid as a contractor because the state law requires it. So those folks are technically contractors and they are eligible for PSLF. Otherwise, you have to be a W-2 employee. That is very clear for the rules that they have. So I hope that answers your question there. We'll go through a couple more here. I have plus loans that have been double consolidated. So they're direct loans on the SAVE plan. So yay, we did the double consolidation correctly. And we've been gaining PSLF credit. We're halfway there. Last child is still accruing plus loans. Did I just hear that I can roll this current plus loan into our already established direct loan that is halfway to forgiveness before April 30th without resetting our PSLF count? So kind of tricky here. Yes and no, right? I feel like that's my answer for everything. So yes, there's deadlines here at play. So the existing Parent Plus loan that you have, of course, does not have any credit towards PSLF because it's brand new. Let's see. Oh yeah, I was gonna say. Okay, so we have a Parent Plus loan, no credit. We have an old loan with credit. The Parent Plus loan can't simply be just consolidated with your consolidation loan right now because then that loan is tainted. Then we've completely undone the double consolidation. We've had a Parent Plus loan consolidated in with the consolidation, which makes us only have access to ICR. So that would be a big no-no in my book. But why I say yes and no is after April 30th, they've amended the rules to say that if you consolidate loans with different payment counts, you'll get the weighted average between the two loans. So that's a good thing because that means we're not going to start over at zero, but we're not going to have the highest payment credit. So what I would probably suggest in this case is if we've got a lot of if we've got some Parent Plus loans from prior semesters, like it's not just the one that was just borrowed, but like if we've got some older ones too, it could make sense to go ahead and consolidate that, the Parent Plus loans that we have right now, and then at some point consolidate the two together to get the weighted average. It's probably going to be after April 30th at this point because you have to wait on that one consolidation to consolidate first and then consolidate together. So that's kind of a complicated way to answer that question, but this is why Parent Plus loans are really tricky. We have to be careful about our consolidation trail in the timeline. Another thing to mention is double consolidation, like getting access to these cheaper income-driven plans does expire. We're not going to be able to do the double consolidation after July 2025. So I'm sure we are going to have plenty of webinars coming up on Parent Plus loans specifically, but if you have Parent Plus loans, make sure to do a student loan consultation with us or a follow-up consultation with us because things have changed over the past couple of years, and that can help you really hone in on what your best game plan is going to be and get as much as possible, as much credit as possible towards PSLF, and make sure that you feel comfortable about your journey with those Parent Plus loans and PSLF as a benefit. I feel like I said consolidation like 12 times. Sorry. All right. So let's get going. So a couple quick things that we could mention that tie into TIAA, saving for retirement, that can positively benefit your student loan plan. So filing status, I think Dan, you mentioned this a little bit. Filing status can definitely help exclude spousal income from your student loan payment. We do talk a lot about that in our newsletters and then in our blog content on studentloanplanner.com. So that's something that you can do to exclude your spouse's income from your payment. Another change also is it used to be it didn't matter who claimed the kid on the tax return. You would be just a family size of yourself and however many kids you had. Now it does matter. They made some changes to that once the SAVE plan came out, and they said, hey, if you're filing separately, you can only claim the kids as part of your family size for your student loan payment calculation if you're claiming the kids. So if you're the borrower, ideally you're the one borrowing or you're the one claiming the kids. There might be some tax specifics there that you need to check with your CPA on, but that's what's going to help get you the highest poverty line deduction, which will then reduce your student loan payment. Another thing to mention is you can use alternative documentation of income to verify your income for student loan purposes. So let's say the tax return last year, for whatever reason, is not representative of your income right now. Like maybe you sold a lot of stock last year, had a big capital gain, something like that. Not really doesn't show your current income. You can submit alternative documentation such as a pay stub or a W-2, for example, and that could suffice to update your payment and keep it truly closer to what your actual income is. And then the last thing, which we've talked about a little bit already, is contributing more to TIAA, your 403B, 401k, 401a, 457, whatever it is that you've got that's pre-tax. Contributing to those accounts does reduce your adjusted gross income, which makes your student loan payment lower. And that's ideal for PSLF because if we're going towards PSLF, we want to pay as little as possible to maximize how much we can get forgiven. So I'll pause. I think Travis was interested in sharing something, right?
Megan, is it okay if I share some discounts the folks in today's webinar can't get anywhere else? I'm so excited you said yes. I'm so excited. I
muted myself too soon. Sorry.
I thought I was so scared you were going to say no. So real quick, I'll put this link in the chat. And I'm going to share my screen so that folks know what that link does in the chat. So, host disabled screen sharing. Can we enable that?
Fault. Yep. My fault. Let me go find it.
She just had a feeling you were going to join, I guess. It was just like
I just can't resist.
She's like, really I'm the captain now.
while she's trying to figure,
Bumper guards, right?
yep,
Should
that's
work now.
right. So, all right. So that link in the chat will take you here. And these are the best discounts we offer anywhere. And we're offering them just to you because you sat through this whole webinar. Thank you. Wow. There's like other things you could have done with the past hour, but you sat through with
Yeah.
us. Yay. So what it's going to ask you is just a series of questions, and it's going to direct you to the place to get you the biggest discount on exactly what you want. So it's going to say first, did you do a consult with Student Loan Planner before? Yes or no. So that's going to give you different options depending on what that answer is for the discounts you get, right? So if you've already done a student loan consult, then it's going to ask you, do you want Sam, Kathleen, financial planners like those two for $99 a month with that special discount rate? If you say yes or maybe, it's just going to confirm that you want to become a financial planning client. So you can say, I'm ready to go now, and you'll just go straight to the scheduler. If you say that you're unsure, guess what? That's okay. We have actually a free 15-minute phone call that we can do to help you ask whatever questions that you have in your head that is preventing you from wanting to move forward. So there's that if you have done a student loan consult before. Now, if you've not done a student loan consult before, we also have discounts for you too. So if you've not done a student loan consult before, it'll ask, do you have debt or not? If you say you don't have student loan debt, then it's going to put you through that same yes, no, maybe logic about whether or not you want to join SLP Wealth. And it's going to give you the same options of I'm ready to go, I want to do it now. And it's going to give you the I want to do a 15-minute intro call first. And then if you have student debt, but if you have student debt and you have not done a student loan consult before, it's going to give you three options, right? It's going to give you the options for student loan consult only. So that's if you're just not interested in recurring financial planning, right? If you just want our one-time student loan consult that we're famous for without doing any financial planning, you can do that. And we're going to give you $100 off. If you click that submit link, it'll take you to the right place. So that's a special discount we don't normally offer. Now, if you want to get an even bigger discount because you also want financial planning, then you can combo package it. You can do the student loan consult and financial planning, and it's going to give you both of those two together with bigger discounts, right? And if you're unsure, as long as you understand that those intro calls are only for folks who are considering financial planning, right? Not people that are unsure about doing a student loan consult, then if you're unsure, then that'll let you schedule an intro call as well. So this has really got something for everybody. If you are at all on the fence at all about any of our services, that's the one link that you can get to the right place with. And so we'll probably send that out later. But again, I'll put it in the chat again for anybody who needs it. And then if you're already a SLP Wealth client, thanks for attending this too. You can reach out to your financial planner, who's probably Sam or Kathleen, I would assume, but there's maybe a couple that aren't. And then you can have conversations about whatever's on your mind. But yeah, we made this form like just to try to make it a little bit easier for folks to just get whatever discount that they're most interested in. Not everybody's going to be a financial planning client. Some people just want to do the one-time consult. Some people really want profession-specific planning from professionals that get your profession, that not just get it, but deeply are passionate about serving this profession. I think it's so amazing that we've got planners that are dedicated to helping public servants, and that are passionate about it. You're not going to get that most places. And I think $99 a month is even, that's not nothing, but it's affordable for most professionals in the nonprofit and, higher ed and secondary and primary school settings to be able to afford that, which is really important to us. So, yeah, I don't know. Any other comments? Remember, folks, just that link in the chat, and then watch out for Megan's email later if you lose it or forget. But that's the only spot you're going to get discounts like this.
Yeah, we really hope that everyone got value on the call. We do these calls to offer tips to the do-it-yourselfers and also offer a way for people to get professional accountability, either on a one-time basis with their student loans, and now, as of last year, on an ongoing basis with everything around it, which is the bigger picture.
I will say one more point. The availability is not as good as you might think. So there's no times in March yet, but there are times in April, right? So if you go through that scheduling link, the people who are ready right now are going to get a lot better times to sign up than people who need to do an intro call first, right? And then if you do that intro call, you decide you want to move forward, you can schedule it out, but it might be, if you look at the availability, the soonest is April 5th. So you might be looking at a week or two or even 3 weeks before you're able to get on the calendar to have your first onboarding meeting. So, if you're at all interested in this in any way, I would suggest going ahead and scheduling it because we don't collect a credit card up front, so you can cancel it if you change your mind later. Thanks for letting me parachute in, guys.
Perfect. Yeah. Thank you guys for joining me today. Dan is keeping us on schedule. We're going to close out and, thanks for hanging out. Check out future webinars in our newsletter that we send out, and I'll send out the recording with the recap later on, and just let us know how we can help you out. But have a great rest of your week, everybody.
Thanks for joining, everyone.
Bye.